Hi, everyone. Welcome to Andromeda's Q4 webcast. Thanks very much for joining us today. We have Alberto Gallo, our CIO, Aditya, Aney, PM, and Tao Pan, who's our head of research, who are going to cover the outlook and opportunities that we see, particularly in the credit space for 2024. So please feel free to ask questions along the way. You can add them in the chat or send them directly. We'll start with a presentation and then leave time for Q&A at the end. And Alberto, Adi, I think you're starting if you want to take it from here.
Thank you, Hope. My name is Alberto Gallo.
My name is Aditya.
And today we're going to spend around 15, 20 minutes on the top-down backdrop for credit markets and the opportunities that we see today and going into 2024. It's a pretty exciting environment because we already have seen this year some moments of volatility as we go towards the end of this credit cycle. And for next year, we expect even more dispersion and volatility and good risk premium to be taken on the table in credit markets. So let's think about the main views that we have around the outlook today and next year. But before that, one thought about this year is we started with a lot of recession views as a consensus at the beginning of 2023, and we started with only barely one hike priced at the Fed. And we ended up with several hikes that the Fed made throughout the year, no recession, a pretty strong economy, and a pretty solid market environment for equities and credit. And looking at what the market is expecting right now, one song comes to mind, which is One More Time from Daft Punk. It seems like we're back to Goldilocks. It seems like investors want to party after the big risk-off events of the last few weeks and the geopolitical risks of the last few weeks. There is, again, a lot of expectations of rate cuts, of immaculate disinflation, and a very, very benign growth inflation mix priced into markets for next year. So we think the market is attractive, but right now it might be a little bit, time to trim and take a little bit of profits and think about next year. And so what are we thinking about next year? Well, first is, our view is that there's too many cuts priced, both at the Fed and ECB. And as a result, some of the investors that are looking forward to Goldilocks, to low rates, low spreads, might be a little bit disappointed. We're also still looking at a strong economy, especially in the US, so no recession, very low probability. But this also means that there is still a chance that inflation might be stickier than people think. And yes, we had some very, very benign prints. We had a retreat of inflation from very high levels. But inflation comes in waves, and there is a repricing of labor that's a global phenomenon. And in addition, we'll also have more geopolitical risk next year. It's a year with many, many elections. So we think that in the end, some of the dovish positioning and the reaction function that central banks have highlighted, including the hawkish members of the ECB like Isabel Schnabel or Waller at the Fed, some of this maybe it's preparing the ground for the BOJ to hike. And that's something that the BOJ needs to do, whether it's December or Q1 next year. We think it's going to be earlier than expected. But maybe there's been a little bit too much dovish speak. So we do expect more volatility again. We have been capturing it this year, and we're pretty excited about next year. So very quickly, our forecasts are no recession in the US and growth above consensus for the US and a little bit below consensus for the Eurozone. So more divergence between the US and Europe. Inflation ends very likely still above target at the end of next year, even if oil prices stay low. And as a result, the fair value for rates and spreads is a little bit higher than what we have right now today. And that's not bad news. It means that there'll be more opportunities to lock in pretty substantial yields, pretty attractive yields, which are now, in the low double digits to high single digits area in pretty good credits in the high yield space. But there are risks to this benign, base case, and I think that the tails both the left tail and the right tail are not really priced into markets today. So there is a left tail, which could be that we get less growth and a bit less inflation. And then there's a right tail, which is reflation, which means that, with fiscal spending still going really strong, some consumers and some economies could reaccelerate later next year. It's not the base case, but some reflation risk could happen in the US, where we see consumers still spending and borrowing even at high interest rates. And a slowdown risk is probably more likely in the Eurozone, where we see more weakness even in the main countries, in the core countries. So in this scenario, we probably see inflation, continuing to go down, and inflation has been the driver of markets, of rates and credit, in the past few months. But we still see it stabilizing at an above target level. So the last mile for inflation is going to be challenging for central bankers. And the question is exactly, what's the terminal rate, where how much can the central banks cut without a big increase in unemployment? What kind of benign cuts will they be able to make next year? Today we have 150 basis points priced in the US, and nearly 130 in the Eurozone, and that's a little bit too much for a benign cut regime. So that prices in some probability of a recession that we see as much lower than what the market expects. And the risk is that with inflation staying above target for a very long time, as the Bank for International Settlements has shown, there is a risk of entrenched inflation, of wage negotiations, becoming sticky, and inflation staying above target, becoming almost the single pricing device for a lot of goods. So rather than having different goods moving in different directions, inflation becomes entrenched. What makes us comfortable about having a benign environment for growth and also for credit for default rates is also that fiscal spending continues to be strong and above target. And let's remember, next year we have elections in the US, in the UK, Euro Parliament elections, and also elections in a number of emerging markets. So it's a year where governments will continue to spend at a clip of between 5 and 6%. And even the countries which were more hawkish from the spending budget side, like Germany, are still spending at a rapid clip, and the off-budget funds are sometimes bigger than the budget funds. As you can see on the right, Germany is spending close to €1.5 trillion next year. So rates markets, well, a month ago we were all worried about the supply of treasuries and whether we were going to be able to absorb that. Today, everyone is long duration, and yields are going back to 4% on the 10-year, and there's 6 cuts priced in. We think that's a bit excessive. There are still many reasons why, especially the long end of rates, will probably stay high in this cycle compared to the lows that we reached during quantitative easing. And some of these are structural reasons. So we do like the rallies, we do like being tactically long, but we don't think that this is the end of higher for longer. We don't think we're going back to boons at 1%. We really need a strong recession for that. But we still have trends that tell us that the labor force is more scarce, and geopolitical risk is here to stay. And as a result, when we see these type of cutting cycles being priced in, probably we're thinking about a deja vu versus the beginning of this year, where a lot of sell-side banks were calling for cuts, and a lot of investors were long duration. We are thinking about no cuts for the Fed next year. That's our estimate. Maybe 1 cut in Q4, but definitely not in the first half of the year. And even if the ECB might cut earlier in Q2, they probably are not going to do 5 cuts throughout the year. You really need a big deterioration in the economy. And we see that there is spending in the Eurozone, and the need for spending is coming from core countries, unlike during the Euro crisis. Now, one of the reasons why we think that inflation still stabilizes above target is that central banks haven't really tightened for the richest top 50% of companies and individuals, households. The tightening on the front end part of the yield curve affects short-dated borrowers, short-term borrowers, so SMEs, and so small firms and households that own less assets, that borrow with credit cards and auto loans. And unfortunately, those are the weakest households, but they also are the ones that drive a smaller part of the pie, of the consumption pie. We do see weakness. We do see a gradual weakening especially in the bottom 50% of the households and in small firms, which corresponds to the levered loan market in credit. But we see less weakening in the wealthiest half of the economy. In addition to the fact that essentially central bank hiking has been a bit lopsided, a bit only focused on the front end, so there hasn't been a lot of quantitative tightening yet. The other thing that makes us a little bit more convinced about sticky inflation is that we have a repricing of labor. Globally, labor is still scarce, even though job openings are lower, and we have a return of geopolitical risk. So we have seen it this year. There's now 2 proxy wars, and the supply chain gets affected by this, and onshoring is a result of this. Next year, we have elections. Spending will continue in the US, Eurozone, UK, but also in Mexico and South Africa, which will present some interesting opportunities in our view. And generally, the reason why we're excited about this is that when there is higher geopolitical risk, investors tend to retreat ahead of it. But following these events, generally markets perform better, and active strategies that are on the right side of geopolitical risk, as we've been in the last several years, tend to also do well following these events. A few words on the divergence. It's going to be a year of divergence, and 2024 is going to see more divergence between the US and the Eurozone. The US is still doing well, consumers are solid, and it's spending. The US is spending at a faster pace than Europe. In Europe, we see a gradual weakening and a technical recession in some countries. In the US, on the other hand, labor markets continue to be solid, even though there is less job openings. There is still a lot of jobs still available. So we might see, a little bit less openings, but we still see low unemployment in our view, and maybe a little bit of uptick in unemployment. But in our view, this does not correspond to a recession. In Eurozone, things are a bit different, meaning that there is less lending. There is there is a problem with some of the core industries in Germany. For example, the auto industry is challenged by competition from China, and so there needs to be a rethinking. And productivity growth in the Eurozone is also lower. Spending continues, but some countries can afford it less than others. And next year we'll see probably less retail demand for spending, for government issuance. For example, in Italy or in countries that this year have used a lot of retail demand to absorb their government bond supply. The UK is a special case. We're in stagflation, and we continue to see a sticky inflation number here with a much worse growth picture than in other countries. Bank of England has gradually deteriorated in credibility, and we think they should have done more. They won't be able to cut as much as other central banks. We do think that supply constraints in the UK will make inflation really hard to bring back to target. China is just too weak. China is not going to recover, but unfortunately, they are managing downside. So unfortunately, they're not going to recover, and we don't think it's really investable. But the good thing is that the tail scenario of a deeper recession is avoided, and that benefits Europe. And finally, the elephant in the room. Japan could become a substitute for China in terms of being, Asia's manufacturing base in the future. Japan is going to benefit from a lot of movement of production from Taiwan, and it does have that skilled labor force that is needed to reshore, semiconductors and manufacturing in advanced value-added sectors. So Japan is one of the beneficiaries of geopolitical risk. The BOJ is the elephant in the room because it's still keeping rates where they were before, and they need to go back to positive. And we do think that this could be a surprise. Investors have been calling for, thinking about the BOJ hiking. And 1 year ago, the conditions were not there. and the BOJ created a lot of volatility in the market. But today that inflation is lower in developed markets, in the US, in the UK, in the Eurozone, the conditions are there for the BOJ to start a hiking cycle, potentially without creating a global tantrum. But it does bring up the ceiling. It does bring up the floor for interest rates. The BOJ was the anchor for a long time for BTPs, for OATs, and was one of the reasons why Japanese investors bought a lot of duration across the world. So generally, it's an environment which has gone back full circle. We started with a lot of Goldilocks pricing at the beginning of this year. Then we had high rates, some things breaking in the financial system, some opportunities in financials following the Credit Suisse event and SVB in March, which we captured, and then other opportunities in October following another pricing of a recession in Europe because of the unfortunate Middle Eastern war. And so these events have provided good entry points in credit. But where is the value in credit? There's a lot of buzz around credit, a lot of investors that have not done credit for a long time and are looking at credit for the first time in 10 years. And for a reason, obviously yields were low. And now there's more dispersion, there's more vol. It's an interesting asset class, but where do you go in credit? So this chart shows you where we have, shows you the different sub asset classes of credit and where yields are. And on the left side, you see munis and mortgage-backed securities and investment grade. On the right side, you have the most subordinated parts of the market, like unsecured lending, credit cards, and private credit. There's a lot of love for private credit. But the reality, and there's also a lot of love for investment grade. Everyone loves to be long, high-quality credit. You probably don't get fired, but for 60 basis points, there's not a lot of value there. And on the sub part, on the right side, yes, you are getting a little bit of extra pickup sometimes, but the quality is so much lower, and some of these areas of the market have never really experienced a credit cycle. So the sweet spot, in our view, is right in the middle in domestic markets, in companies that are above, that are below investment grade, but that are above, the most subordinated parts of the capital structure. And in general, these are good companies, and they've been able to sustain and refinance throughout COVID. So you had a lot of the bad names already being taken out. We'll talk more in detail about what we like in which sectors, but generally speaking, as you can see here, what we see is that rates are above average, real rates are above average, and spreads are also above average. Are they above average right now? Well, they were a bit more attractive in October. They're still interesting. But generally, the all-in yields in credit are pretty interesting. And, on top of that, our job is to generate alpha from volatility, from long and short positions, from new issue premium, and from, single name specific events like M&A, changes in management, and so on. So it's a pretty attractive asset class, not just because the valuations are interesting, but also because as companies are no longer dealing with 2%, 3% funding, but 5 to 10% funding, there's a lot more intra-company, intra-sector moves that we had not seen for a long time. And our job is to distinguish between the good names, which are there and pay you some good yield, the bad names, which are not going to survive, so they're good shorts, and then in the middle, the ugly ones, which are going to have to sell assets or restructure or merge, which sometimes provide more value. Now, what's the status, what's the situation of high-yield firms in Europe and in the US? Well, there's a lot of firms in some sectors that levered up with 2% interest rates, but generally high-yield firms as a whole have not levered up. They were already pretty careful about leverage when interest rates were low. And the maturity wall that a lot of people talked about is something that has been really pushed forward towards 2025 and actually 2026 in the high-yield space is really where the maturities are. There's very little refinancing that needs to happen next year. So a lot of the names that needed to refinance have done that proactively. So with this picture in mind, even if central banks don't cut as aggressively as markets are implying today in rates, we still think that both from a top-down and from a bottom-up perspective, default rates are going to be really benign. And with this, I'm going to turn the word to Tao, who's going to talk about how we analyze default rates from a top-down perspective, and then Adi will go doing a bottom-up deep dive deep dive into the sectors that we like, and then we'll close with the opportunities that we see in the market. Tao, the floor is yours.
Thank you, Alberto. So as Alberto was saying, we see more volatility, more dispersion, but we don't see a very deep distress cycle. And there are several reasons for our view. So firstly, we look at things from a macro point of view. And in our view, we see a relatively low probability of a recession over the next 12 months based on our models, looking at the economic data over the past many recessions and compare that to the current data. So based on that, they see still very healthy household balance sheets, and we still see continued government spending, and this will support growth. And that means we are not going to see unemployment rising by a lot, and that is generally a very favorable macro environment for high yield. And secondly, as Alberto explained earlier, we still see strong corporate fundamentals, and as we show in the last slide, the high yield companies in the US and in Europe, they haven't relevered, and their leverage still remains much lower compared to previous cycles. And thirdly, we also see still a lot of money on the sideline, and there is still a lot of stakeholder support and government support for firms. So putting all these factors together, in our default models, we see default rates rise to 4.1% in Europe and 4.4% for the US over next year. And these are higher than the current levels, but you can see here, they are still much lower compared to the highs in the previous cycles. So overall, the high yield default picture is not as bad compared to the previous credit cycles. Having said that, like Alberto was also saying, it's important to really distinguish the firms that will actually be able to get support, get financing, versus those who will not. And now I'll pass on to my colleague Addy, who will elaborate on the opportunities we see.
Thanks, Tao. So as Alberto and Tao have been saying, if we summarize what we've been hearing so far, growth remains, we're not in a recession, and growth remains above target. Default rates will rise, but modestly. And generally speaking, both household and corporate balance sheets in a healthy space. When you put that together, credit spreads look wide relative to fundamental levels as well as relative to other risk assets. Now, in the last 1 month, we've obviously had a pretty big rally in spreads. We're about 100 tighter than where we were sort of mid-month. So it would, there is opportunities within that. But from an asset class perspective, overall, spreads are still attractive, especially sort of in the high yield space. What we've been seeing over the last 1 year has been an increase in dispersion. What you'll see on this chart over here is on the right, you've got the US, on the left, you have Europe. What you'll notice is that we're seeing a bit more dispersion in the US than Europe. We expect the general dispersion to continue. So we don't think we're going to go back. So even though the market might price Goldilocks today, we think this is not an environment where all boats are lifted equally. Dispersion will continue as firms can and cannot survive this more complex environment of higher inflation and higher rates with thinner margins. One of the things which we haven't heard, though, at all in sort of the last 12 months, where some people were expecting at the start of the year, was a rise in defaults. Now, part of that is down to fiscal, but part of that is also down to the fact that we've seen an incredible increase in some of the private credit strategies and private credit assets. In our opinion, as you can see on this chart, there is no real value in the private credit assets. Specifically, you're getting paid more or less the same in private credit than you are today in the secondary market. Put it differently, there is very little of an illiquidity premium. But what does the private credit strategies mean for the secondary market? What we're seeing is the fact that Alberto sort of mentioned before, this people keep talking about the refinancing wall that was supposed to be in 24 and trigger defaults that didn't. And part of that has been basically that we've seen that as maturities have come out, there's been an increasing bid for essentially taking out some of this debt and making it private. What that means for secondary is that you're basically, at today's yields, have almost in some ways a backstop to some of the private assets that essentially want to take out what we think are some of the worst or some of the more levered firms with sort of the thinnest margins. So what does that mean? As we sort of been highlighting, spreads are wide, but it's not generically cheap at this point. So when we start thinking about, how we find value in credit and don't find value in credit, to put it very simply, it's a three-pronged approach. We think about the issuer, which is essentially, can they deal with higher rates? Can their balance sheet deal with higher rates? Or can they pass on those higher rates through higher margins to find the end consumer? Do they come from an industry where there's support, either from the government? So for example, it might be in a strategic sector, or from the shareholders, or perhaps from other competitors within the same industry. So is it a strong industry? And finally, bond features. Essentially, what is the duration of the asset? Are the coupons high enough such that it's not as duration sensitive? One of the interesting things that we've seen in the last 3 weeks of this rally is that there's been an incredible bid for high coupon bonds, and the bid has been much, much slower for lower coupon bonds. And the reason for that is just because of the inherent volatility of lower coupon bonds. So we look at sort of these three features for us to pick, as we like to say, between the good, the bad, and the ugly. So then if we think about, what are the things today that we like? Where do we find value? What do we like and what do we not like? So on the long side, to talk about three sectors to begin with, we have banking, energy, and gaming. So within banks, we still find the European, especially the European periphery, where we think there are a number of shorts. The spreads in the tier 2s and the AT1 space is still attractive. You still have between 500 to about 700 spread in some of the periphery names, including sort of Greece, Italy, and to some extent, even Spain and Portugal. This is much wider than the US peers, where, if you think about Schwab and so forth, where essentially they're trading at 200 basis point spread, and they're much more sensitive to higher duration assets. Energy is another space which is very interesting for us. There has been a sell-off in oil, and this is creating an opportunity. So now oil's hovering about the $70 mark. We have names which are trading between 600 to 1,000 basis points. Now, in some cases, it's government support entities like Pemex, but in other cases, it's also oil exploring companies like Ithaca and Quest, sort of based out of Europe. And these all typically have leverage of under 2 times with an oil break even of $30. So they've got a pretty comfortable cushion that you're being paid for. Gaming is another sector which is relatively anti-cyclical, but again, has a spread of, in this case, between say 400 to 600 basis points, predominantly in Europe and some of those names. And leverage there is typically sort of under 4 to 4.5 times. And it's been a sector which has historically been quite defensive. Finally, when we think about mezzanine tranche, or basically your second loss to default piece, this is one part of the market, especially on the high yield side, which is still pricing in a very high degree of defaults. And we'll get into this in a bit more detail in a second. But here you're still getting paid, above 700 basis points in spread, and you're essentially cushioned for the first 10% of default rates in Europe. And as we'll see shortly, in Europe, it's historically been very rare, or it's only been 3 times in the last sort of 20 years. We've had above 10%, and even then it's been capped to about 11%. So those are sort of on the long side. On the short side, what are we looking at to short? They're basically, I would say, about 2 broad aspects of it. One is cyclical IG exposed to the bottom 50% of consumers. As Tao and Alberto was saying before, there is fiscal policy. People generally have relatively strong household balance sheets, but this is more skewed to on the top 50% than the bottom 50%. And the bottom 50% are getting more hurt by higher rates. So when we think about some of the IG cyclicals, trading under 200 basis points of spread with above 4 to 5 times leverage, this doesn't make sense. Think about casino operators, some of the auto parts in the US. These are typically cyclical 5 times leverage 200 spread. We sort of expect a repricing sort of going into Q1 next year. Another sort of is vulnerable emerging markets. Generally speaking, we don't find value EMs with the exception of 1 and 2, but it's a sector where we're seeing there has been exposure. There have been outflows in the asset class. Spreads are relatively tight, especially compared to DM peers, and we sort of see that as sort of being a rich asset class in general. And then finally, with SPV capital structures were built for the Goldilocks environment. There have been a number of different business models that have spun out of that, but effectively, this is where you have assets yielding today under base rates, and they're not profitable unless rates go basically below 2%. REITs is a very common example. We use that mostly on the trading sites. We like to trade, short to neutral, that depending on where we are in the cycle, because they're not outright shorts at these levels, but there are other versions of this like SoftBank and so forth. I'll pass to Alberto now.
Thank you, Aney. So essentially, we're in an environment where growth is still positive. Probably today, spreads are a little bit on the tight side, but still above average. But there's been panic buying in some sectors. We'll have more volatility next year from a number of sources, including dispersion, including single name widening, and some central banks needing to hike, like the Bank of Japan. So, what is the way you want to invest in credit? How do you want to position? And the long story short is we love being paid close to 10% plus roll down, so higher than that, to be the second loss taker, which means we don't want to be the guy that takes the first defaults in the index, the worst apples that are falling from the tree, which is what you see today in distressed markets. Complex capital structures, names that cannot bear 5-10% refinancing costs. Those are the first parts of the credit market that are going into distress. And by the way, there's a lot of money in competition to refinance those firms, but we don't really want to do that. What we love in a rising default environment, still late cycle, but not in crisis, is to be the second loss taker. So to have substantial margin of safety against this rising default rate. And on the right side at the bottom here, you see the loss rate, so default times 1 minus recovery for the crossover index for 20 years of history. So 40 series of the crossover index. Each series has a maturity of 5 years, and each series is rolled every 6 months. So 40 series, 20 years of history. What you see here is that very rarely the crossover high yield European market went over 10% of realized loss. Very rarely, for a number of reasons. And the widest names in the market are on the left. And yes, there are names that are bad and will probably have to restructure if there's a recession. But there's also names that have substantial shareholder support, substantial government support. I'll give you, Telecom Italia, Finnair, Accor, Burger King France, Fnac, Montepaschi, TUI, any sector. All of these names are high yield rated, and they had over 100 million of help or guarantees from the sovereign in the respective countries since 2020. So the reality is that, yes, you are getting paid a little bit more to buy government bonds, but why do that if private companies, the private sector, and liquid markets, liquid bonds, that yield a lot more, are also benefiting from government help. So we do love the mezzanine risk, both the 10-20% and the 20-35, which is even more far away from any loss. And these are instruments that we have been exposed to and obviously traded throughout the year. We continue to have some, and it's something that we love because also it simplifies our approach to investing in this part of the cycle. So it's been a good year. We're happy about our performance, and we've been up every month so far with a beta to the market that's basically near 0.07, and with very limited drawdowns. We continue to like credit. We continue to look for opportunities both directionally, and always money is always at work on a relative value basis. It's not just about the moments of volatility. There is new issue premium, there is M&A, there is sectors which for the first time in years are consolidating, like periphery banks or telecoms, which couldn't do that before because earnings were low. There's a lot of divergence across sectors as well. There's bad sectors like REITs and chemicals, and there's good sectors that perform well in this environment like energy and financials. And there's a big divergence across regions between the US and Europe. So it's a pretty exciting environment going into next year. Again, there is Goldilocks pricing, which is where we are able to finance hedges, even for the medium term, very cheaply, which then allows us to buy better in moments of fear. And what are our conclusions? There's Goldilocks again, but the tails of the distribution, recession in Europe and reflation in the US are a little bit underpriced, even though those tails are not the base case, but the probability is low. So it's an attractive optionality to have. We think the Fed could cut less than expected, and the BOJ could hike. Those are some of the volatility triggers, but we're also always looking for things that could break. For example, in the US regional bank space, Adi mentioned Schwab, but there's also Truist Financials. There's other names that have a lot of duration, and also in the middle market insurance space. And in Europe, in chemicals, in autos, for example, as well as REITs, which is already a weak sector, and we don't think it offers a lot of value. So overall, credit offers good value as an index, but as an index today, it's a bit tighter than it was 1 month ago. So you have to look in the niches where the value is still available. So some banks, some energy, periphery, Greece, and in some cases also UK names, and some names in the US. Why is credit not going to have 10% default rates? Why are people waiting for a distress cycle, going to probably be disappointed again next year? Well, because there's a lot of money on the sidelines already, because the long end of interest rates is still very low, and private credit funds availability has cushioned the refinancing need of firms. So the firms that needed to refinance in public markets sometimes went to public markets. We saw an airline in Eastern Europe doing that, and the cost was too high, and then they get financing in private markets. It's probably a phenomenon of adverse selection, which means we wouldn't really want to be in the private lending side here, but it benefits public markets. So we're pretty happy about the first year for Andromeda. We thank you for your time on the call, and for the investors, we thank you for your trust, and we'll now go to Q&A. Let's see if there's any questions from the audience.
Yeah, so we've got I'm going to start grouping these together, and they've been sent bilaterally, but if you have any more questions, feel free to send them bilaterally or in the group chat. So the first question that we have, essentially, it's a great one. To recap the question, basically, we've had very little pushback from central bankers on some of the dovish rates being priced to markets. I guess the question is, why do you think that is? And are you expecting sort of a reversal or some of that rhetoric sort of going into Q1?
So I would say that it's a bit bizarre that, for example, Isabel Schnabel and Waller have been dovish after so much was already priced in terms of cuts in the market. And remembering what happened last year, I think generally central banks are a lot more sensitive to financial instability events. So we've seen them intervening very quick after Credit Suisse and also in October. And I think here the fear is that if rates were already at 5% and the BOJ started hiking, then treasuries could go to 5.5 and cause another tantrum. So I think that they probably prepared the ground for something from the BOJ in my view. There's definitely been coordination across the various central banks. We've seen it 1 year ago when the BOJ, when Kuroda tried to hike, and then essentially he was stopped by the volatility in the market. So I think it's a preparation, and I think the hawkish rhetoric is not gone, but it's a matter of coordination between the Fed, ECB, and the BOJ, in my opinion. We've got another question just coming.
So the other question is a really good question. I think it talks about the insurance space. And if I can just summarize it, it's essentially asking, given the fact that the insurance sector seems to have pursued balance sheet intensive and capital light structures, what are your thoughts on the impact of leverage loans and private capital on effectively the private insurance space?
Yeah, I think that's maybe for you, but we've been asking ourselves this question a lot, because usually there's a lot of focus on banks. And banks have seen a lot of stress in the last 10, 15 years, but the financial system operators that sometimes own a lot of duration and own also sometimes illiquid assets, are some of the insurance firms, especially in the US, especially some of the smaller ones. And so are they sustainable or not? Or should they fund the 200 basis points?
Yeah, so I mean, without spending too much time, this is a really great question. If we think about the US financial market, the banks, the insurance, it's sort of a barbell of two things. On the bank side, you essentially have, or not the bank side, but some of the bank side, you've got a risk of higher yields, and then owning those long-term duration assets like Schwab and so forth, which are at risk of that. On the other side, you essentially have some of these tier 2 players in the insurance space, which have bought a bunch of CLOs and are at significant risk if there's an increase in defaults. So we find that from the short side a very attractive trade, but I think more specifically because you can't time it, it's more interesting to pair that as a long against some of the second to default tranches in Europe, because we essentially think if there's a pickup in default, so US will get more hurt than Europe.
Well, essentially, there's still, apart from regional banks, there's still some areas of the market where there could be some damage if there is a rewidening, if there is a widening in spreads or rates. Generally, again, it's been a pretty good year. Despite the volatility in rates, we've seen relatively limited volatility in credit, limited defaults this year. Generally, I would say next year we would probably see a bit more vol, and maybe some of these sectors will come under pressure. So, we are now even more looking for things that can break. But overall, there's a long list of things that you can buy that are still pretty good in credit, given the environment, given fiscal spending, and given the cushion that's offered by private debt funds. So I think, we're pretty good on time. We don't have any more questions at the moment, but feel free to follow up with us. Thank you so much for your time this year, and we look forward to seeing you again in 2024.